2, time-based. So here I've put X minutes after the trade. So there's two ways of looking at a time-based trade. The first one is to literally have the number of minutes after the trade. Now, when would you use that? When would you say to yourself, listen, 15 minutes has passed since the trade, I'm coming out. That would work well if you're trading day trading perspective and you're trading the open. Let's say you're trading the opening drive and you're looking for a continuation, or you're looking to fade that initial momentum, whatever it may be. You may well say, listen, if this is true momentum and it's just running out of puff and it's just gonna struggle, then I don't want to see this anywhere near this price point in 15 minutes time, because I believe that it's just the initial rush coming in and that's what I'm fading. So it becomes a little bit like a premise based, but you're putting a bit of a time frame on it and saying, listen, if this is going to do what I think it's going to do, it needs to do it in this window. Otherwise, the thesis of the trade is incorrect. If you were fading a lunchtime sort of drift up, very, very quiet lunchtime, you don't want to be holding that trade in the close, because the premise is that you're fading some lunchtime chop or whatever it may be. Similarly, on a daily, from a swing trading perspective, if you're trading after earnings, for example, and you think there's momentum, you think that the stock has been repriced, you're getting involved on the long side, you may well say to yourself, listen, if it's genuinely short scrambling and it's going to cause this to go higher, we've got institutional involvement, going to cause this to go higher over a 2 or 3 day period, maybe after day 2, if it hasn't moved, you're out of the thing. So that doesn't necessarily have to be minutes, say putting for minutes from my perspective, because I'm much more of a day trader, but it could easily be days and say, listen, it doesn't do it by 2 days time, I'm out of the game. So that's your time base, that's the specific minutes, and that just goes understanding the cycles of the market, understanding the different phases of the market, whether you're trading intraday, whether you're trading daily. The open is different to lunchtime, is different to the European close, is different to the US close, all those kind of phases. Similarly, on a daily chart, Monday trade after a long weekend is going to be different to Friday when we've got data or non-farm payrolls. Completely different types of trade. So you may well assess your time-based trade based on something that potentially could be coming out that could affect the trade. The second one here is I put XX hours actual time. So this is more a case of two ways of looking at this. One is, as I've just mentioned, there's data coming out. If you're intraday trading, or even if you're day trading or swing trading over a sort of short period, like a week, then you might want to say to yourself, listen, as we come up to data coming out, I don't want to be involved in it because the volatility may go anywhere and I'm losing control of the risk. You may also say, I don't want to be involved in this if I'm trading this and it comes to midday, because I know from midday till 2 o'clock or from 11 a.m. till 2 o'clock, the market I trade tends to go quiet. So I just don't want to get involved in it. So if it doesn't do it by this time, I'm out of here. It might be something like, listen, I want to come out 15 minutes before the closing bell because I don't want to caught out in the scramble. Something like that. So again, time-based, you may well use that in conjunction with your premise-based, because you're going to have to cap your risk at some point. So you may well say, listen, my stop is 95, whatever that may be, but actually I'm also going to add a time-based variable to it, or parameter to my stop loss risk management, which says, if it doesn't do it within an hour, I'm out of the trade anyway, because it was a momentum play, it was based on, whatever it may be. So, that's something to look at, time-based stop. Very useful, that, very, very useful. And it stops you getting frustrated, and it stops you kind of sticking with a trade when the premise has gone, because, we're all guilty of being a little too much biased once we're in the trade, and sometimes come out of it, you can reassess it, if it still looks great, then hop back in. It's no big deal. Commissions aren't that expensive these days.